So yeah, just a Q&A.
Hey everybody, it's James here with Dan Barofi. We are here for another edition of Real Estate Tip Tuesday, and we're going to be talking about one of what is stereotypically the least sexy but most important pieces of your wealth strategy. So obviously we want to talk real estate, but real estate is a huge keystone brick in the foundation of your financial future, your wealth plan. And you know what they say, you got to protect your assets, and life insurance in itself can be an asset if you do it the right way. So I said, Dan, you know what? This has been a topic of conversation. It's been on my mind because I actually got my annual statements from my life insurance policies and was licking my chops, looking at my cash surrender values. And I was like, you know what? This is worth talking about because not enough people know about it. So Dan, why don't you say hi to everybody and welcome to Tip Tuesday.
Hey guys, thanks for having me. First Tip Tuesday here. So glad to be here and shed a little light on the topic we're going to discuss.
I love it. I love it. Now, Dan, here's the thing that a lot of people don't have any idea about, and that is if you set up your insurance correctly, you actually build an asset that has tangible value, that has a collateral value that you can then borrow against down the road. So just like when you buy a house and you pay off the mortgage, you can refinance that mortgage and use that money to invest. Your life insurance policy does the same thing. And I don't think enough people get that and understand that. And so that's what we're here to talk about today. So if you could start elaborating, I'd really appreciate it.
Yeah, absolutely. I think the common knowledge when it comes to thinking about insurance, because most people buy term policies to cover mortgages, wage replacement to supplement that. But there is another option. It's permanent life insurance, whether it's through what we call a whole life policy or you can also do a universal life policy. But the thing is, why it hasn't really come to light in Canada, it was more for the affluent market, very high premiums. But what it typically is, it's a tax shelter, and CRA allows us to invest in a life insurance policy without being taxed to up to a certain point. We still want to use the insurance for the reason of coverage, but now, especially with the company I work for, Sun Life, they pivoted towards allowing middle class to gain access to these kinds of products. So what this allows us to do is reinvest into the dividends. They pay that out to you, but what happens is we reinvest it into the insurance policy so it grows tax-free. So you're tax sheltering your money. Down the road, the policy pays for itself while your death benefit is still growing, which builds your estate. And we can now gain access to the policy cash values through either collaterally assigning it to a third-party lender, which is the most tax-efficient way to do it. We can go into more detail if you guys have more. I won't go into that too deeply right now. Or you can take a loan against the policy. So it's pretty much being your own bank. And it's pretty much the same as interest rates from a third-party lender. It's all determined on your credit rating, obviously. But through Sun Life, you can actually borrow against the policy itself, and it builds substantially. You can also overfund these policies. So there's a base amount, but like I said, CRA will allow you to overfund it to a certain point to keep it on side with regulations, and they grow substantially. Absolutely. Hope that answers your question, James.
Yeah, it does definitely answer my question. And you said it's like overfunding your policy is basically like doing a lump sum pay down on your mortgage at the same time. So let's just mess around with some numbers because I think it's good to use an example to illustrate. But let's say that you want to have a life insurance policy for like $500,000. If that's what you call that term life policy, then you pay a little bit of money every month to kind of access that policy for a certain number of years. But once the time expires on that term, then the insurance disappears, right?
Yes.
Whereas like a whole life and a universal life policy work differently. So can you kind of explain what happens to that $500,000 over time?
Yeah, we weren't going to do any streaming because of the disruption. So how can I put this, give you good numbers? So I'll base this off of a 35-year-old male on a $500,000 whole life policy. Within 10 years, the policy will pay for itself. So the cash value, but let's say the annual premium's $30,000 a year. The policy will pay itself off in cash value at about year 10. At year 15, you'll be heavily in surplus for the cash value. The thing is, we got to remember, we can use these cash values to either stop paying for the policy, we can keep funding them. So they're very versatile in that way. But at about 65 years old, just let me check. I'm actually going to switch off because I did send James these numbers just to give you guys an idea quickly. 35, no fund. There we go. Yeah, so at about year 10, so your first year you've put in on this, there we go. Sorry, guys. So this is based off of 45-year-old male. So the total premium here yearly is about $21,000. At about year 10, the cash value in this policy has already reached about $215,000, with the death benefit going from $500 to about $635,000. Now, obviously, this is compounding, right? So the longer we put money into these things, the better. And whether we need to use them, that's the decision later on in days, whether we use it to fund retirement, or if you don't need the money, this just multiplies your estate. Because if we take a look at, by the time this 45-year-old is, let's say he passes away at 80 years old, the policy is now worth $1.3 million with a cash value of just over $1 million. So that's kind of the power and what we're trying to teach people. Everything has its own unique use, TFSAs, RSPs. Teaching people how to use life insurance as an asset is kind of what I'm trying to do now. Now, it's not fair. It depends on the stage of life, but you know what? It's definitely another financial vehicle that we can use.
Yeah, and it makes perfect sense, because like with the type of policy you're talking about, you're buying the value of that policy to own as an asset. And so it's it's just like it's kind of like paying off like a stock or a mutual fund or any other asset. Like you actually own that policy, and that policy is something that has a cash value. So that's why it grows, because there's market appreciation involved with the value of that asset. So when you get it set up at 500, it ends up going to, in your scenario, like 1.3 or something like that, which is kind of cool. So it ends up forming a part of your wealth building strategy. And just like Dan mentioned, for those of you guys listening, it's tax sheltered. Like that, all that growth happens without you paying any tax on it. And when you pass away, that money gets transferred to the next person without any tax. So it's a huge tax shelter, which is kind of neat. Now,
intergenerational wealth transfer.
Yeah, exactly. Now, in terms of utilizing that money for like something like real estate investing, about how long does it take for that to grow to the point where you can start borrowing, say $100,000 against it?
So if we overfund the max at the start, James, you can pull money out pretty much within the first 5 years.
Amazing.
The good thing about the whole life policies, I'm sticking with the permanent whole life policy, is that when we borrow against it, it doesn't affect our death benefit. It doesn't pull away from the death benefit, which
right.
is, and for anyone that's possibly using this in a holding company, whether it's holding company or personally, it's a tax write-off loan. And the best thing about it, when we borrow from it, what we do is called leveraging. So the third-party lender will give you 90% of the cash value. And the thing is, you can choose to pay it back, or you can choose not to, because they're not really worried about that, because your death benefit is going to pay off the remainder of that loan. And then the remainder of your death benefit is going to go to the beneficiaries.
Yeah, exactly.
So it's a huge tax advantage. And it's, like I said, it's becoming more easy to get it to the masses nowadays. It used to be a more of a, like I say, like affluent market, but now we're getting into the middle class because it works, right? It really does. So
yeah, no, I think it's a great program. So for those of you out there who are thinking about rounding out your financial picture, I mean, we talk about real estate investing all the time because it's such a great piece of your portfolio. I mean, you want sometimes you want to flip or pre-sale to build equity boosts. Sometimes you want those buy and holds to build cash flow. But, I mean, I think there's a lot of people out there that are just like, I just do real estate and that's all I do. But, I mean, I'm definitely a believer in diversifying. I mean, that's even like what Robert Kiyosaki says in his book, is like the cash flow quadrant, have multiple places where you have financial stability in your life. So, I mean, RRSPs, not a terrible idea. TFSA, maybe play around a little bit and invest in some stocks or whatever, or EFTs. And the other place that it's very easy to save is that life insurance policy. And then, you can fund your life insurance policy as a savings vehicle. And then when that benefit grows, you borrow against it to have a down payment on property, which is a very, very popular option. And I think that's something that gets lost in the shuffle and lost in the translation. So Dan, thanks for coming to talk to us just a little bit more about how life insurance policies work, because I think a lot of people just assume it's for when you die, but if you set it up properly, it actually becomes an asset that, you know, you can borrow against, you can use for real estate or something like that. So I appreciate you coming to clear that up.
Yeah, 100%. And if there's any more information people need, obviously send them my way, and I can go in more depth with it.
Of course, yeah. I mean, we're doing a quick like real estate tip. Check out life
Real
insurance.
estate tip.
You know, like if you want to get a deep dive into it, Dan's tagged in the post, so make sure you guys give him a holler.